This is a very elaborate setup for a panel discussion. We have dry, we have sparkling, right? And we have a very nice, tiny bouquet in front. If you remember what Fred said at the opening, he said last year, everything that can happen has happened, right? I would paraphrase Fred, and I will be a bit more candid. Last year, everything that can go wrong has went wrong, right? Big jump in US dollar, big jump in interest rates, a very, very explosive, commodities market because of Russia's invasion of Ukraine, so on and so forth. So everybody knows the title for this roundtable discussion, Turning Risk into Resilience. There's a lot of risk last year, right? There's a lot of volatility, and there's a lot of fear and confusion. So it is with great privilege today that we're able to invite three of our very valued customers from very different client segments, very different industries, to join us today to share with us, and to basically share with us their candid thoughts about what went wrong last year, how do each of their respective firms manage, the risk and volatility, and what do they look out for this year in terms of, the challenges, the new strategies, how do they, react to China's sudden reopening of the economy, so on and so forth. So there's a whole list of questions that's in fact been given to me before through the RMs, through the sales, relationship managers on how to pick all three of your brains. Having said that, if you guys have any more questions, do put through the QR code, and we can pick it up and add on, from here on. So before I start, a very quick introduction again, just to do justice to our three panelists. We have Angela from Wholesale Investment, we have Silkin from Capital and Escort, and we have CY, as we call him, from Minson. And of course, Peter represents UOB. He will share with us our house view. So I'll start first by by probing their minds about what to expect for markets, about interest rates, US dollars, commodities. So Peter, perhaps you can share with us UOB's house view from what do we expect, for the US dollar, for interest rates. Do you think, US dollar has seen the highs, and how much more pain can we expect for interest rates going forward? Peter.
Yes, thank you, Kun Hao. So thank you everyone for being here, and wishing you a happy new year. If there's one word to summarize what we think for this year, the word is normalization. So the painful year of last year, perma crisis, is probably over. And let's set the backdrop for this year. In terms of growth, we are expecting recession in the Western economies, US, Europe, and also UK. The good news is it's likely going to be a shallow one, 0.5% for each of those economies. And I think at the turn of the year, we do have positive news from China about reopening. That should cushion the rest of this part of the world, which is ASEAN, Asia. We should not see recession this year. And in terms of inflation, the good news is that it's probably turning lower for this year, but not enough to go towards the 2% mark, which most central banks are expecting. So most of the rates will stay high. So let me jump straight into our view about the interest rate market. So we are probably at the tail end of this very painful tightening cycle that you have seen in the last 9 months or so. So just to recap, US rates ran from 0 to 4.5% in the span of 9 months. So that is a very strong rise. We are at the tail end. We are only expecting another 75 basis points from the US. And as you know, when the Fed do something, the rest of central banks follow. So as the Fed is expected to conclude their rate hikes in the first quarter, we expect the rest of the central banks to more or less conclude their rate hikes. This is, of course, premised on the assumption that inflation will gradually turn lower. But of course, I think we can reasonably expect major central banks to continue to be a little bit more sensitive towards inflation. So if they do see that inflation is entrenched it's not coming down as fast, then probably they'll still maintain a tightening bias. Yeah? So that is on the rate. So to put some numbers into context, for US Treasury yields, we're expecting to stay at around 4% for the entire year. For 3-month SORA Singapore rates, we're expecting a gradual grind towards 4.3%. So to just wrap up our rates view, rates will stay a bit on the high side, but thankfully not going a lot higher. In terms of FX market, I think the painful year is probably over. We have seen that the US dollar has started to turn around starting October, November last year. It should continue to go lower gradually, but we are not expecting a collapse of the dollars like what we expect in previous cycles. Reason being because the Fed is still on a tightening bias. They are not going to cut rates as yet this year, so US rates will stay high. Yeah? So because of that, on the FX market, when the US dollar is expected to turn around gradually, we are expecting it to happen in the first quarter of this year against major currency. And against Asian currency, we are a little bit more cautious because China is seeing this explosion in cases right now. So the China recovery will happen a lot later. And when that happens, the Asian currency recovery against the US dollar will probably happen at the middle part of this year. So it's like what Tekin has mentioned, it's going to be a tale of two halves. So a weaker Asian currency in the first half, followed by a very sustained recovery in the second half.
Thank you, Peter. So I guess everybody heard the message. If it all goes well, the US dollar will turn slightly lower. Interest rates may not go that much higher, but unfortunately, the Fed is not in a hurry to cut rates. Interest rates will not come down anytime soon. So perhaps, Angela, the first question goes to you. Now, LaSalle manages a whole portfolio of investment real estate all across Asia. Now, clearly, rising interest rates is bad for how you guys look at it in terms of investment costs, and the stronger dollar eats into returns as well across the region. So how does LaSalle manage this dynamic?
Okay, Happy New Year, everyone. Start with a happy note. LaSalle is an investment management company. We do investments in Asia across 5 to 6 different countries. So I do look at it as a basket of currencies from a treasury perspective. We tend to be very disciplined about FX and interest rates. So because our core strength is in real estate investment, so we take out all the noises around FX and interest rates. So we have been hedging, and with the dollar being strong and the Asian currencies are generally weaker, actually it's a very good point in time for us to invest. So actually last year, despite the crisis, we actually deployed a lot, and I think UOB saw a lot of the hedging.
You're funded in US dollar, right?
Yes, exactly. So our currency denomination is US dollar. So that's where we deploy more into Asia. Then in terms of interest rates, we are also very anticipatory. We have actually hedged quite a lot of our loan books across Australia dollar, Korean won. We kind of left Japanese yen alone, and then renminbi cannot be hedged, obviously, and Sing dollar, we do quite a fair bit of hedging. So actually, we are kind of like mark-to-market game right now. Then going forward, even though you heard the economists and the specialists saying, maybe 75 basis points hikes. But what we do as a team, again, very disciplined, we build in all the expected hikes. We do stress scenarios very much like a bank. We are risk managers. So we've got all that baked in as well.
Okay. So good to hear that if you listen to what Angela is saying, I've been counting the number of times she said the word hedging, right? She mentioned the word hedging 6 times. So there you go.
Yeah.
Okay, Siew Kim. Yeah. Now, Ascott CapitaLand, right? You guys have quite a few growth engines. Now, specific to Ascott, there's 2 major engines, right? One is for hospitality, and one is for real estate investment as well. All this volatility in financial markets, US dollar and currencies cut both ways for you guys. So how do you manage that noise?
Okay. Hi. Okay, thanks, Kun, for having me. So just give a bit of context of where I'm coming from, so that you know the comments I give is actually based on the hats I'm wearing. So I'm from CapitaLand Investment, from the lodging part of the business, which is the hospitality arm of the business. So I come from the happier part of the business, because hospitality is travel, and travel makes people happy. So Ascott actually has two engines of growth, like what Kun said. We have the investment management arm, which is the real estate part, and invest in the lodging business. That part of the business is anchored by largely our CapitaLand Ascott Trust, which is a listed REIT. We also have private equity fund on that part of the business that invest in value-add investment and then the balance sheet investment. So the investment management part of the business has close to about 10 billion kind of investments on that portfolio. The other part of the business for Ascott is, of course, the managing of the hospitality products under our Ascott branded properties that we manage third-party owners' property. And that is the asset light of the business where we generate fees. So on your questions on rising interest rates and also Forex rates, how does it impact the business? I would say it's largely impacting the investment part of business. And I echo what Angelia said, but there's this new IRR hurdle that we talk about. Tekin has talked about the 5R. I have a new IRR. It's called inflation, rates, is interest rates or Forex rates, and the other R is recessionary. So that's like almost a key headline and things that we talk about when we do investment now. But specifically on how we manage the risk, I have 3D. 3D approach on risk management. And it's very similar to what Angelia just said. The first D being discipline. Discipline, the approach on how we manage our risk through hedging as well. So I think we have very similar investment management strategy. Being disciplined in terms of our VZ study. So that's the first D, which is discipline. Second is D for data. I think the data analysis is very important when we do our investment analysis. And that part of the data we do investment, actually a lot gets supported by the banks and of course Kun and the team and the research report that we get that gives us some forward view of what's happening in the market and economic view. So that D is important. That's why the earlier advert, the UOB guy was saying he worked day and night, right? Actually, it's true. Because we can call them and say, we are doing these investments, please provide information, and they turn around very fast. That's why the bank slogan is called "Right by You," right? Yeah. And
this is not scripted, by the way.
And the last D, I'm not paid, I just asked for lower margin, that's all. Can I write on that as well? And the last D for me, managing a portfolio of hospitality assets over the COVID years, I find the most important D for me is diversification. So having a very diversified portfolio have helped me see and mitigate some of the risks that we experience in a volatile market. So that's my 3D approach of risk management. Yeah,
so Siew Kim, if I can add to that, right? All of you need a special B. You need to work with the right bank. CY, Inson is in the energy space, right? Clearly last year, commodity markets, energy markets, crude oil, you name it, is topsy-turvy, right? All over the place. You can hedge at the wrong time, at the high, or you can be very unhedged and it goes very wrong. Inson has, basically ridden this volatility. How do you manage that, and how do you help customers manage this volatility in energy markets?
I think if we talk about Yinson, we are in the energy infrastructure space. So that's really where we invest in, and most of our investments are there. And if you talk about the oil and gas side, it's not just been a bad 1 year, it's been a bad decade. So companies that, we've seen two very negative oil price crises in 2014 and 2020 with the COVID crisis, and generally the companies that didn't survive were not surviving, didn't collapse because of 2020, but really 2014. So generally there's not many players left in the oil and gas business. So what it brings me to is that the oil and gas business is very disciplined today. right? So everything is, you don't take forex risk, you don't take interest rate risk. And that's the discipline that most of our peers have. And also we match our income to our debt. In terms of currency, we lock in long-term interest rates. So yeah, we have that sort of discipline. And I think that discipline is very important for us to move forward as well, given that our infrastructure space is very long-term in nature, and that's how we see. But we do see there's opportunities coming up in our energy infrastructure space. There's a lot of demand for energy. There's not a lot of supply in the last 10 years. Like I said, we've had a very negative 10 years. And therefore, it's the first time we see that supply, there's not enough supply at the moment, and there's a lot of demand. So that means that our clients are also willing to take on the high interest rate risk, take on these high interest rates, and that gives the opportunity to pass costs on for passing on these high interest rates for long term to our clients who are solid counterparties, and allows the refinancing later on in years to come. So I think that there is opportunities as well.
So, CY, I want to pick your brain on this one. You're, again, in the energy space. Where do you see crude oil going? Don't quote our forecast. But given where you see in the industry, given where you see Russia, is happening in Ukraine, where do you see crude oil going in the next 1 year?
Thankfully, we are not in the business of crude, and also we help produce for our clients oil and gas, but we are not in the business of speculating. But I must say, I'm very positive in the long-term price of oil for a few reasons. Very limited capital has come into the business. As you know, the oil price moves up, from 100 to 20, 20 back to 100 on very small marginal supply-demand differences, where it was like 3 million barrels caused it to come from $100 to $30, right? So with very little investments into exploration activities in the past 10 years, it's not like you want to produce oil, you can produce tomorrow. It takes at least 7 to 10 years. So I do believe there's very little capital going to the business. There's going to be a shortage of supply. Mm-hmm. And I also believe because of this, it will drive transition faster, because solar, wind are just so cheap compared to oil and gas today, right? So that's the other opportunity there is, right? Yeah.
So I want to echo CY here, and this is our house view at UOB as well, that oil prices will trend higher given all the supply issues. And over the near term, it's simply because everybody is afraid of a recession, right? Uncertainty in China that has kept oil prices low. But objectively, if you look at all the supply indicators, they are tight, they are very volatile, if that's the word to use. So again, a common denominator here, if you hear the message, is that markets can be uncertain, volatile, but do hedge your risk, whether it's interest rates, currency, or crude oil. Remove the external risk, then you can run your business and concentrate on maximizing your operating returns. Moving on, a lot of questions on China, right? How do you see China's reopening affecting inflation, what do you expect, so on and so forth. I'll lump it all together in this China segment. I think everybody wants to know what to expect for this sudden reopening of China. I will pick Mr. George Yeu's brain later as well to see if there's any insights from Beijing about whether they have a plan about this reopening. But first, Peter, can I ask you what is our house view on China's economy for this year? What do you expect?
Sure. So I think you're right to say, I think everyone is caught by surprise, the sudden shift from zero COVID to endemicity in just 1 month. I mean, it's reported that if you look at the numbers on the first 20 days of December, it's estimated 18% of China population has already gotten COVID. So that's 1% a day. So if you just take a linear approach, 3 months, everyone should get it. Yeah. So, but it's amazing. I mean, the shift is amazing. The investors, the market's perception shift is also amazing. In just 1 month, the market has went from uber bearish China to where do I put my money in China right now. So there's a big shift. What are we looking at for the Chinese economy? Like what Tekin has mentioned, 5.2%. This is definitely a step up from the 2.8% last year. But if you look at the potential for China, if you remember pre-COVID, 6.5%. So even at 5.2%, you are not reaching potential yet. And out of this 5.2%, we are fenceling about 4 percentage points due to consumption alone. Why is consumption such a big thing for China? Because let's not forget, they have not spent in the last 3 years. They have not ventured out and buy their luxury goods for the last 3 years. They have not traveled in the last 3 years. And even internally, when they move around and buy their things, they are always very scared that when I will get locked down, so they don't travel that far to buy the things. They don't shop in peace. So when that happens, right now, the pent-up demand, when it happens, it will cause this massive consumption rally, domestically at least. So there's going to be a V-shaped recovery in terms of consumption that is more or less guaranteed for China. So that is why we are looking at 5.2%. But let's not forget that the virus always surprises us in many amazing ways. I bring you back to 2021, where at the start of the year 2021, we thought that, wow, we have a very rosy outlook, we got vaccine anyway. So then Delta came. And let's not forget 2022, we thought, wow, we've beaten Delta, then we have Omicron. Yeah, so China, I mean, in a way, we have not seen this playbook yet where, wow, you can get infected so fast, so furious. It doesn't mean that at the end, by March, everyone gets infected in China, you can just return to work and nothing happens. The virus always can surprise us in some ways. So I think that is, we have to stock check on the sentiment rally right now, and really we think that in the first half, maybe let's be a little bit more cautious about China. The recovery, when it comes, is likely going to be in the second half. And the other thing that I'd like to let you bring away is that the external environment is still very challenging. So out of the 5% growth this year, 4% is internal. 1% that we forgot is actually the external one, which is very, very uncertain, which is net exports from China is going to be very low because we are expecting recessions in US, UK, and Europe. So you have low demand in that kind of backdrop. So I mean, near term, don't get too excited over China. Let the numbers speak for itself. When we see a few months of positive data, then I think we can expect that maybe a second half recovery for China.
So this is that double circulation model for the Chinese economy. The external sector may be difficult, right? You can't control how exports are doing. You can't control when Europe will exit recession. But what the Chinese is trying to do is the internal circulation, the internal spending, if it goes well, should carry the growth for this year. So short term a bit uncertain. If it goes well, the year should progressively get better. I think this next question has to go to you, Siew Kim.
Okay.
You are the direct beneficiary of China's reopening. and I remember we had this conversation before. You said your rooms are already like 90%, almost 100% filled before the Chinese announcement that they're reopening.
That's right.
So many questions to ask. Is traveling going to change now that they're reopening? Do you see a big inflationary boost? There was a question on China's reopening. How does that affect inflation? Do you see you guys jacking up prices 50%? No. How does that work?
Okay, yes, China reopening, definitely positive for the travel industry. You have read headlines on how bookings have increased. Searches for travel outbound has definitely increased over the last few weeks. So a very positive play for the travel industry, and you've seen how stocks relating to hospitality has recovered, in fact positive return. So inflow of funds for hospitality, that's great, largely because we are seeing increase in demand for traveling arising from post China reopening. But if you you look at it in context, right? China have not been traveling for the last 3 years, and as you rightly pointed out, they have a lot of money to spend. And the cash deposits in China actually has gone up over the last 3 years. So revenge travel will definitely happen. 2019, before COVID hit us, China, I read somewhere China tourists were close to 155 million. And they spend more than $250 billion on tourists. So can you imagine all that money coming back? Yes. So yeah, definitely positive on China reopening. First half, it will take some time for the adjustment to be made for traveling. But there's no doubt that the traveling will come back. And like what you said, I chat with Kun once a while and I let him know. But even before China reopened last year, fourth quarter, we already see a very strong demand, even without the Chinese traveling. So we are definitely very positive that this year the travel recovery will happen in this sector. Yeah.
Okay, I want to pick your brain on this, and this is more of a personal question, right? Tickets have all jumped,
Yes.
right? Hotel rooms have all ran up.
Yep.
As a consumer, given you see in the hospitality space, which country, which city should we go for holiday next?
Anyway, choose travel, you only live once, so please choose wherever, clear your bucket list and enjoy traveling, yeah.
So travel before the Chinese come out.
I think they're a bit out already, so. But most of us have been traveling since last year when the borders opened.
True.
So, yeah.
Okay, so Angela, in my conversations with you, you have always been the devil's advocate, the more, balancing and cautious one. Now, clearly everybody is in the euphoric camp, right? What do you have to say about China's reopening? How does that affect the regional economy? Is there any dose of reality that you would like to remind all of us?
Okay, yeah. Of course, travel is wonderful. We are also hotel owners, so thank you. So, so we picked the right team there. But again, a bit more cautious. I would say cautiously optimistic and pessimistic. I think that's where we come from. So China has always been a theme of Wholesale, huge part of what we do in Asia. In Asia, we are just Japan, China. Really. And then Korea, Singapore, Australia are the smaller markets that we're in. We look at China top down and bottom up. And our strategy is long China. 20 years. We've been around 20 years and China is long China. We'll be here, 100 years and it still be China. Okay, so with that, I don't need to belabor why China. I think every one of you, are experts in it. But I think the cautionary tale is we have to write with China, right through China, right with China, go along with their policy. So everything that we do, our sectoral pick in China has to do with mirroring the government's policy. So I'll give an example, right? I think this again should be very, very familiar to a lot of you here, like e-commerce, logistics, industrial park. So this is what CapitaLand Ascendants used to do. Wholesale came in a bit later, obviously, but we ramp it up. So we are big owners of e-commerce, modern logistics, again to support the fast-moving goods, the consumer industry, and also belatedly, because of the pandemic, again this is where we pick our niche, there is a lot of demand for cold storage. So we're thinking, right, how do we build up cold storages? How do we cater all this to our tenants? So again, this is one example. The other two other sectoral pick, one of them a little bit more cautious is a little bit to do with demand and supply. There's a lot of selectively, there might be a bit more supply of, say, office building in China, right? You all know they have a lot of CBDs. Unlike here, we are very simple. We're just a small island. Theirs is like, I couldn't even figure out how many CBDs there are in Shanghai, and yet we owned office buildings. So I think as a responsible investment manager, we do need to think about what we have learned from the pandemic, okay, and we need to learn to regentrify all the buildings that we own, really thinking about mental wellness for our tenants, for our staff, thinking about catering to this new hybrid work style, someone to work from home, someone to work in the office. How do you attract people back to the office? There's a lot of literature on all of this. And again, as real estate owner, you've got to be very, very cognizant of this. And then, get your building really green and up to speed to cater to all the tenants and staff. So that's another sector. And then last but not least, I think there's one sector here which Singapore feels it a lot because our residential prices is sort of like gone through the roof. I'm expecting with the Chinese coming, there will be even more, so we should all be long real estate somehow. And in China, I think we are also seeing that trend. People are moving closer to CBDs, closer to their working area, reducing the commute time. And in particular, tier 1 cities, I think affordability is an issue for the younger folks. So again, we've got to be clever, I think, about building things to cater for their needs. So we are also now thinking about residential as well. So this is an example. Yeah. So cautiously optimistic and pessimistic.
Slightly less pessimistic.
Maybe.
So if you heard Angela, right, long China, right? Okay, CY. Again, the pandemic affects everybody, right? Irrespective of whatever industry you're in, you're affected. And I think, who was it? We were discussing earlier, one of the ladies said that all of us have scars from the pandemic from the past 2-3 years. So how does Inson manage the disruption to your business, and what do you see next from China's reopening?
I think what happened with the pandemic, and pre-pandemic, we were already talking about flexible working. And the pandemic took it to really only work at home, right? So thankfully, we were, in a way, semi-prepared for it. But we talk about China, and China has been quite crucial in our supply chain. I think when the pandemic struck, what we did was we allocated most of our supply chain into China. We went all into China for the delivery of our assets. And I think it was the right strategy, and it was probably the only asset that was delivered globally on time, in our business, on time and on budget. And that was purely because of China. And China was still keeping the world moving. Of course, towards the end of the project, which was last year, I think the situation was very much different, and I think we were quite worried about the repeated lockdowns, which affected timelines on our project. Thankfully, enough contingency, and therefore last year we actually pulled out some of our work in China to put in different parts of the world, such as Dubai, Indonesia, and all. So I think China opening up is really good for us. It's China, no matter how, it's going to be a very extensive part of your supply chain. We spend a lot of our capex in China, and having this opening up allows us to send our engineers to solve issues instead of nobody wants to go to China because of a 1 month to 2 months kind of quarantine. So a lot of and for the wellness of the people, quarantine for 1 month, I think it's just not there. So I think with the opening up, I think it allows us to have more. It will allow us to definitely deliver faster our projects. It will allow us to send our good people into China to speed up deliveries and things like that. So, yeah, I think China reopening is going to be very beneficial for the global supply chain. Yeah.
So I guess we can't ignore China. China is big. China is a very, very important part of our region, right? All of us invest in China as well, and of course, China affects the investment, the tourism, the spending in our region. Now again, do work with your sales RMs, relationship managers. UOB is here to help you, whether you're investing in China or whether you want to expand across ASEAN. And this is an interesting time, at the very least, that China is reopening. So the dynamics, the positive vibes are back. Peter, now back to you quickly. Now, I want to round off this roundtable discussion with what we can look forward to for 2023. Now, there's a lot of debate, both sides of the fence, on whether you're going to have a soft landing this year or very, very, bad hard landing. Right? Nobody's sitting on the fence here. What's your view? Soft or hard, or somewhere in between?
To be honest, I actually like a little bit, a bit more than soft, but definitely not hard landing. Yeah. So why do I say that? Because we have to understand what caused the pain last year. Inflation caused central bankers to freak out, and hike rates aggressively. So in order to not let this trend continue, we sort of need to think what the central bankers really want to reverse trend. So for them to reverse trend or at least not continue to hike so aggressively, we need growth to soften materially. So that is my argument where we need a slightly more than soft landing, but definitely not a hard landing. So currently the market is pricing in that the rates will stay high. So we need growth to come in a little bit, to have enough growth concern so that central bankers will say, maybe I can consider to put in 1 or even 2 rate cuts at the end of the year. So that will be the important message I think they are looking at, or at least they're looking at. I think this year, growth concern will become a bigger thing compared to inflation concern. So that is the thing I'm looking out for this year. So definitely not on the fence. So I like a little bit of pain, but not too much. Yeah.
So a bit of objectivity from Peter. Growth slowed down, but not as bad to affect investments, not as bad to affect job markets and financial markets. So again, I want to stress, I want to end on a positive note here. So quickly for all 3 of you, what are the opportunities do you see for 2023? And if you can share with us, one positive thought as well that you can expect. So Angela.
Okay, positive thought. I mean, I don't really have a lot of positive thoughts because I have a lot of capital to deploy.
There you go.
So I
Who's
could talk
looking
down
to
the
sell
market.
their properties?
Looking for valuation adjustments. Okay, so I'm actually more aligned with Peter there. I want a little bit more pain. There's not enough pain, so that I can deploy smartly for my investors. Actually, relatively speaking, I think relatively, I'm just looking at the world globally, Asia is in a very good position, relative, okay? So if you ask me, if I'm coming from a global perspective, actually I'll put my money in Europe. So that's one idea for the audience here. I don't know whether you do Europe. The other idea that I have, of course, we are real estate investors. We do first loss, okay? We have to hunt and eat. If we don't hunt, we don't eat, right? So I'm thinking I might redo my capital stack actually because interest rates are so high now, with a little bit of pressure on valuation. Actually, it's pretty good to be in, if you're interested in mass debt, that'll be one idea. Preferred stocks would be another idea. So again, this is just thinking thematically and in the big picture. Thank you.
Siew Kim, something positive for 2023?
I'm definitely positive. I've been paying for the last 2-3 years, so I don't any more pay in the travel. So yeah, so post-COVID now, travel is back. I'm definitely positive. Travel should be back. I think there are questions on rising costs and impact of travel, but I don't think that will stop travel. We are still going to travel. Travel creates happy memories. So please continue to travel. And when you travel, please stay in Ascott properties. But just ending on the note, I think we are, going to a new year, new lunar new year. We are ending and leaving the ferocious tiger behind, and entering into the year of water rabbit. And it's supposed to be a lucky year, yeah. So rabbit's supposed to be more calm, more peaceful, and I hope that we all hop into a new year, hop to your next travel, and hop into a more peaceful year. So that's my ending. Yeah. Thank you.
Thank you, Siew Kim. CY?
I think we see a lot of potential in sustainable investments from last year and the next decade, not just this year. And you have to start somewhere. We've seen how solar was heavily subsidized just 8-9 years ago, and today it's the cheapest form of power, right? So I think it's something that we will continue to invest in clean tech, ESG investments, and what the world used 100 years to build, you're redoing that in the next 10 years. So I think we see that there's a lot of opportunity in that segment.
Okay, so again, don't forget your long-term priorities, right? Don't forget your long-term strategies. We had 1 or 2 years of difficulty or 2 or 3 years of unpredictability, but looks like the economy, if it all goes well, will come back with a soft landing. A little bit, uncertain in the front end, but things should work out and revert back to, of course, the long-term strategies of ESG, going green, and taking care of all our people, right? On that note, thank you, Angelia. Thank you, Siew Kim.
Thank you.
Thank you, CY, and thank you, Peter. Ladies
Thank
and
you.
gentlemen,
Thanks.
thank you.